In this video, we'll be going over IRS Form 8882, Credit for Employer-Provided Child Care Facilities and Services. So this is a tax form that businesses can complete if they've established qualifying child care facilities and or services for their employees. So there are a couple of criteria, but basically the tax credit is 25% of qualified child care facilities expenditures paid or incurred during the tax year, and then 10% of qualified child care resource and referral expenditures paid or incurred during the tax year. So this is subject to an overall credit limit of $150,000. So we'll walk through this tax form, but I did want to take a moment to walk through some of the explanations as they appear in the IRS form instructions. So first, qualified child care facility expenditures. These are amounts that are either paid or incurred to acquire, construct, rehabilitate, or expand property that is to be used as part of a qualified child care facility of the taxpayer, so the employer's child care facility, if it's depreciable or amortizable property, and as long as it's not part of the principal residence or the residence of any employee. Or they could be expenses, they could be operating expenses for a qualified facility that includes employee training, scholarship programs, and providing increased compensation to employees with higher levels of child care training, or these can also be amounts paid or incurred under a contract with a qualified child care facility in order to provide services to employees. So now there's a note in the form instructions saying that you can't give any sweetheart deals. For example, you can't pad the child care expenses above and beyond fair market value just to claim tax credit. The IRS also provides a definition of a qualified child care facility, which is one that meets the requirements of all applicable laws and regulations of the local or state government. This includes licensing requirements of the facility as a child care facility. It also must meet certain conditions, namely the principal use of the facility has to be to provide child care unless that facility is also the personal residence of the person operating the facility. So as the employer, you can't operate your own child care facility out of your home. However, if you contract with someone who does do that, that is permissible. Enrollment in the facility must be open to employees during the tax year. The facility is the principal trade or the business of the taxpayer, then at least 30% of the enrollees of that facility must be dependents of employees for the taxpayer. So you have to have a certain minimum amount of your employees that are using the facility. And the facility or the access to it cannot discriminate in favor of highly compensated employees. So that covers the facility expenditures paid or incurred during the tax year. We'll kind of go over what this item means in line 3 in just a moment. Let's go ahead and start with the tax form before we get ahead of ourselves. So at the top of the form, we'll put in John Doe's business, Acme Employment Services, and their identifying number. You can do this as a sole entrepreneur on Schedule C. You would have either your EIN, you could put in your social security number if you don't have an EIN, employer identification number outside of your social. So for line 1, let's just imagine that John Doe spent $100,000 on a facility or contract services that meet that criteria. The credit is 25% of that amount, so that's what we calculate in line 2. So in line 3, we'll enter qualified child care resource and referral expenditures that were either paid or incurred during the tax year. So qualified child care resource and referral expenditures are the amounts that a taxpayer paid or incurred under a contract to provide child care resources and referral services to employees. So again, this provision cannot discriminate in favor of highly compensated employees. So unfortunately, the form instructions don't give very clear examples of the difference, but it appears that if you actually contract with a facility or with a provider, then you could qualify for the higher benefit. Whereas if you provide resources, or if you contract for someone, like maybe a placement agency for childcare, if you provide resources that are less intensive, that kind of still have your employees go do much of the heavy lifting, then you would qualify for a lower percentage. So you take 10% of, in this case, $50,000 expenditure. We put that into line 4, so that's $5,000. Line 5 is a pass-through. So if you, if this company, if Acme Employment Services happens to receive K-1s from a partnership or a corporation or estate and a trust, then you would be able to, you would have that credit passed through to you from their Form K or their Schedule K-1s. So what you're looking for, if you're looking at a partnership, that would be on Form 1065. Your K-1 would show a code AH in box 15. Box 15 being the credits, the code being AH. That's the credit specifically for this tax form. S corporations, your Schedule K-1 comes from your Form 1120-S. This would be located in box 13 with a code AH. And finally, estates and trusts, they operate off of Form 1041. Their Schedule K-1 would reflect a code in box 13. So in line 6, we're going to add these totals up. 25 plus 5 plus 10 equals $40,000. We're going to take the smaller of that, or $150,000. We'll put that here. So John Doe as a tax-paying entity could stop here, right here, put that on IRS Form 3800, line 1K, which is in Part 3. So partnerships and S corporations also stop here. They would report this amount on Schedule K. Now, estates and trusts, I took the extra step to kind of allocate or indicate this example. So lines 8 and 9 only apply to estates and trusts with their Form 1041. You have to allocate the amount of this credit to your beneficiaries in the same proportion that you allocated income. So let's just imagine you have 4 beneficiaries and you've allocated 20% income to each of the beneficiaries, and then you've retained 20% into the estate or trust for some reason. Then each of the beneficiaries in this example, you're splitting that $10,000. So that's the amount that would be allocated to them. And then you would retain the rest in the trust. The math doesn't work out here, but basically if each employee received an equal amount of the income, then they should be allocated an equal amount of this credit. So if this $10,000 were being split amongst 4 beneficiaries, then each beneficiary, their Schedule K1 or their Schedule K1 should show $2,500 in marked with the code in box 13. So you subtract the amount that was allocated to those beneficiaries from line 7, and in this case we have $30,000 that would get pushed through onto your Form 3800. Again, same line 1K, that's where this credit goes. So there are a couple of considerations worth noting. You can't take a double benefit, and that's just a general rule under the tax code. So examples of that would be if you claimed a credit on line 7, then the basis of your child care facility has to be reduced by the amount of the credit that was allocated to that expenditure. So let's imagine that $100,000. So that basically, of all of this, your available credits will stop here for this one. Let's just say that $40,000 was your total credit, but you can see that basically 65/8 of that amount, 62.5%, came from this expenditure. So you would have to reduce the basis by that amount that was allocated to the facility. So you would take a credit for the facility, but then you would also have to reduce the tax basis because you can't do both. The allowable deductions, you have to reduce those by the amount of the credit. So if you had other deductions that would have been allowed for these expenditures, you have to offset them. So you can either take the credit or the deduction. You can't take both. Generally speaking, a tax credit is usually far better than a tax deduction because it results in a dollar for dollar reduction of your tax liability. And then finally, any expenditures that were used to calculate other credits, same thing. You have to offset other credits by the amount that you took the credit for here. This also may be subject to recapture. So recapture happens under the Internal Revenue Code, Section 45 F, subsection D, I believe. So there's a sliding scale, and if you sell or if the child care facility is no longer operational at any point before the 10th year, you may have to recapture some or all of that credit. So it depends on what year that is. After the 10th year, then the phase out is 0. But if it's within the first 3 years, you would have to recapture 100% of that credit. And then it goes down in an orderly fashion, years 4 through 10. So we put that table, which comes directly from the code section, into our article. You can find that on our website. Simply go to teachmepersonalfinance.com, type in IRS Form 8882. You should see our article appear. We'll also put a link to this as well as the other tax forms and schedules that we've created articles and resources about. We'll put links to those in the show notes. So that's all we have for this video. If you do like our articles, please feel free to subscribe to our newsletter. If you like our videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, please hit me up in the comment section. Thank you very much and have a great day.